Hello, everybody. It's been a while since I actually did a vlog, and that was because we were doing so many NFO reviews and all in between. So, welcome to Marin Talks, my vlog, where I take you through the steps of investing. Well, we had the budget recently, and in the budget, one of the changes that happened was that ULIPs, where the premium is above 2.5 lakhs, are now going to be taxed as equity mutual funds. And I think it's a great move bringing ULIPs on par with equity mutual funds. For long, I have been asked about why not investment linked insurance. I mean, a lot of people believe that they give guaranteed returns. Your money is locked in, it's growing, it's giving you the insurance cover as well. But a couple of things that you need to know as far as investment linked insurance is concerned. Well, firstly, the cover that's provided there is going to cost you something, and hence, from an overall investment perspective, because you're paying a cost for covering the risk of your life, it's certainly going to bring down the investment returns. Now, the cover that is provided in the ULIP is actually more expensive than taking an online term plan on your own. And ULIPs come with very high charges. So I know right now in the market, a lot of people have been talking and saying that, oh, the fund management charge and everything is very low and it's almost equal to mutual funds. But at the end of the day, I have found understanding insurance statements so difficult. And that's because, they keep debiting the fees on a regular basis, maybe monthly or quarterly. And finally, what I find is that because of all the costs, the returns on these plans actually are never more than 4 to 5%. So it could be ULIP, money back, endowment, whole life, child plan, pension plan, whatever else there are these capital guaranteed plans that everybody's talking about, where they're saying that there's a 8% capital guaranteed return. We have reviewed some of these plans, and you could look up some of the videos that we've done on this, and we have found the returns on these plans are also only 3 to 4%. Now, the big mistake that people make in insurance is that they believe that it's a guaranteed return, and it is not. Secondly, as far as this capital guaranteed insurance is concerned, many people believe that the return is 8% guaranteed, but they're talking about 8% on sum assured, not 8% of the premium. And many times they don't even include the GST calculations in this, right? So, and remember, if the fixed deposit rates today, 1 year fixed deposit rate, 5 year rates are like at 6%, how can an insurance guarantee you an 8% return, right? So, I don't recommend ULIPs at all. When you look at the performance of ULIPs, what you see is actually the fund return. So if you were to check the performance online, you would find that this is the fund return. This is not the actual investor return. Now, what is the difference between the fund return and the investor return? Well, in the fund return, you don't have the charges included, whereas in the investor return, the charges are also included, which is what really brings down the returns. Also, riders taken with the ULIPs are very expensive. So taking a critical illness rider on its own or taking it with a life insurance policy, it's going to be more expensive with a life insurance policy. So I really don't see any need to invest into ULIPs at all, because you can actually do a combination of a term plan, which is very cheap, along with a mutual fund. And this way, you have certain advantages. Firstly, transparency. A lot of people believe that ULIPs are investing somewhere where they're getting guaranteed return. ULIPs also are market linked instruments, and they invest in the stock markets and the debt markets just like mutual funds do, but you're not really aware as to where they're investing, and hardly anybody tracks where the insurance companies are investing. Hardly anybody, I mean investors, don't track where insurance companies are investing, which is not the same for mutual funds. I always find that people tend to look at mutual funds with a tooth comb to see what are the bets that they're taking and stuff like that. Of course, a hell of a lot of flexibility is what you get with mutual funds, because as far as mutual funds are concerned, you can exit at any point in time. And that's not the case with ULIPs, because there is a long lock-in period. Also, there are various penalties for withdrawing early. And hence the product is not flexible and not liquid as well. So at times of need, and as we saw in COVID, where a lot of people had a requirement for money and they could not access money from these ULIPs because these are not liquid. Whereas from a mutual fund, you can take a loan against a mutual fund, or you could even exit partially as well and access your money. Of course, we covered the fact that the returns are higher. I would also like to say that mutual funds are much, much more regulated than insurance products. They have many, many more trading guidelines and many other guidelines to follow, which is actually not followed by the insurance industry. So my suggestion would be not to look at any investment linked insurance product. They're really not worth the time. You're better off doing a term plan for the life cover and choosing mutual funds for the investable amount as well. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye bye.